Hello, everyone. Have you ever seen a headline about a massive corporate merger and just wondered, how on earth do they manage to do that without getting hit with a gigantic tax bill right away? Well, that's exactly what we're going to get into today. We are opening up the playbook that businesses use to completely reshape themselves through what we call corporate reorganizations. When you see these huge companies constantly buying, merging, or splitting up, it can definitely look like total chaos from the outside. But it's not. It's actually a highly strategic game, and it has a very detailed playbook. And in this explainer, we're going to unpack the key strategies from that very playbook. So here's our game plan. First, we'll talk about the why behind all this, the strategic shuffle. Then, we're going to break down the specific tools they use, from these really precise moves to full-on company combos. And finally, we'll look at the disciplined process that professionals use to pick the perfect play.
All right, so we've got the playbook open. Let's turn to Chapter 1. It all really starts with this fundamental question. How do companies pull off these monumental changes without facing a crippling, immediate tax bill?
Well, the answer really lies in this critical difference you see right here. A simple sale, that's a change in substance. You sell a factory, you get cash, and boom, the tax authority gets its cut right then and there. But a reorganization, that's a change in form. Think of it this way. You haven't sold your house and moved out, you've just changed the name on the legal deed. The house is the same, the business inside is the same, it's just the legal wrapper that's different. And the whole system that allows for this tax deferral, it all hinges on this one core principle, continuity of interest. The logic is actually pretty straightforward. Since the original owners are just continuing their investment in the same underlying business, but in a new structure, the tax rules basically say, okay, you can hit the pause button on that tax bill for now. It's a strategic shuffle, not a final cash out.
Okay, so now we know why companies reorganize. It's to maintain that continuity and defer the tax. So let's get into the how. The first set of tools in our playbook are all about precision moves, asset and share transfers.
An asset transfer is kind of like a surgical scalpel in the toolkit. It lets a company precisely carve out one division or maybe just a specific group of assets and move them to another related company. And it does all this without disturbing the rest of the business at all. It's incredibly targeted and super flexible.
Now you'll see two main flavors here, vertical and horizontal. So what's the difference really? Well, it all comes down to the flow of control and future ownership. A vertical transfer moves assets up or down the chain of command, between parent and sub. But a horizontal one shifts them between peers. The choice here has some pretty major implications for the corporate power structure down the line. But what if you don't want to move any business assets around at all? Well, that's where our next tool comes in, the share reorganization. This move is all about changing the ownership structure and the rights of the shareholders inside a single company. And one of the most powerful ways to use this is the value freeze. Let's make this real. Imagine you have two partners, 50-50. They swap their current growth shares for new shares that are frozen at the company's value today. Then, brand new common shares are created, and this time, they buy them in, say, an 80-20 split. Just like that, without selling a single thing or triggering any tax, they've completely changed where all the future growth of the company is going to go. It's a brilliant move for things like succession planning or changing up partner incentives. So, we've seen the precision tools. Now let's look at the real power plays in the toolkit. These are the large-scale moves where entire companies get fused into one. So, how do you actually fuse two companies together? Well, here in Canada, it pretty much boils down to two main roads you can take. An amalgamation, which is a true merger, and a windup, which is really more of an absorption. This table lays out the difference perfectly. Think of an amalgamation like a marriage. Company A and Company B come together to create a totally new legal entity, Company AB. A windup, on the other hand, is more like an adoption. A parent company, and it has to own at least 90%, absorbs its subsidiary, and only the parent company survives at the end. Now, the strategic advantages here are massive. Of course, all the assets can roll over tax-free, that's a given. But the real prize, the absolute game changer, is loss utilization. This is a huge deal. It means a really profitable company can merge with a company that's carrying old tax losses and then use those historical losses to shield its own future profits from tax. But this ability to combine companies, it raises this incredible possibility, especially when a parent absorbs a subsidiary. Is it possible for a merger to actually create brand new tax value? Basically out of thin air. Believe it or not, the answer is yes, through a mechanism we call the bump. This rule lets a parent company increase the tax cost of the subsidiary's non-depreciable assets. We're talking about things that don't wear out, like land.
so that it better reflects the high price it actually paid for the company's shares, maybe years ago. This creates a really powerful tax shield for the future.
So, how is this value created? Well, it's really about syncing up two different numbers. First, you figure out the gap between what the parent paid for the shares and what the subsidiary's assets are worth on the books for tax purposes. Then, you take that difference, that extra value, and you bump up the tax cost of an asset like land.
Let's put a number on this just to see how powerful it is. Imagine a parent company pays $1 million for a subsidiary, but the tax value of that sub's assets is only $600,000. Well, that's a $400,000 gap. The bump rule allows the parent to add that entire $400,000 to the tax cost of, say, a piece of land, creating a massive potential tax saving down the road.
Okay, so we've just unpacked an incredible toolkit of corporate plays. But look, knowing what a scalpel or an amalgamation is doesn't make you a surgeon, right? The real art, the real professional skill, is knowing exactly which tool to use and when to use it. Professionals don't just guess. They follow this really rigorous, iterative process. It's a loop. First, you define the objective. Then, you test a technique by modeling every single tax consequence. After that, you analyze the result. Did it work? Did it accidentally create a new problem? And if it's not the perfect solution, you go right back to the beginning and test another approach. It's a meticulous hunt for the perfect move. In this whole process of choosing the right structure, it brings us to a really fundamental point for any business, which I think is captured perfectly by the quote you see here. Is the way your company is structured a strategic asset, or is it a liability that's actually holding it back? Which, of course, all leads to the big question that looms over this entire field. When companies pull off these incredibly complex moves, are they engaging in smart, legitimate financial planning, or are they just becoming masters at exploiting loopholes? The answer isn't always so clear, and as future professionals, that is the fine line you'll have to navigate. The truth, as it always is found in the details of the playbook.